Reroang Eng, a value-added tax vendor which converts old shipping containers into houses, was incorporated in 2012 and has a financial year end of 30 June. We have to use a VAT rate of 15% in this question. Okay, there you are. The containers are purchased from AJPTY Limited, who focuses on the imports and exports of merchandise to Europe. RB is focusing on converting these containers into houses primarily to be used in informal settings in Gauteng. RB uses a truck to fetch the containers from AJ. Specialized equipment is used to convert a container into a house. Lebogang Mabusu is the financial director of the company. She has recently attended an updating accounting course and mentioned to the managing director that the company has to revisit their depreciation write-offs as the current estimations do not seem to be correct. He promised to support on whatever decision needs to be taken because, in his own words, he doesn't understand accounting at all. Upon further investigations, the following information came to light. Extract from the trial balance as at 30 June, and then I have 2018 and 2017. Truck at cost, 30 June 2017, 1.3 million. It's only one truck there. There's not trucks. Accumulated depreciation on the truck, specialized equipment, and accumulated depreciation on the specialized equipment. The current accounting policy on depreciation states that vehicles are written off on the straight line basis over a 5-year period with an estimated residual value of 100,000 Rand exclusive of VAT at the end of the useful life. Specialized equipment, let's make that a different color, is written off on the diminishing balance method at 20% per annum. The expected residual value of this equipment at the end of its useful life is 50,000 Rand, VAT exclusive. Now, we know that for depreciation calculation purposes, we use a diminishing balance method, that estimated residual value is already included in the 20%, so we do not recognize that. But in this question, there was a change in estimate, so suddenly I need the 50,000 as well, and we will have a look later on how we're going to need it and how we're going to use it. Then on 1 April 2018, the old truck, which was bought in 2014, was traded in for a new truck. The company made a profit of 30,000 Rand on the trading transaction. The residual value of the new truck is estimated at 92,000 Rand, inclusive of VAT. So let's take out the VAT. If we take out the VAT, remember 15% VAT in this case. So 92,000 divided by 15, 1.15 gives us 80,000 Rand, and the estimated useful life of the new truck being 4 years. The straight line basis was continued to be considered as the most appropriate method to apply in calculating depreciation on vehicles. The depreciation charge in the trial balance for the year ended 30 June 2018 was calculated correctly by the accountant. Now, that means that we had an old truck there. We've sold it in the current year. We've traded it in on a new truck. So that 88,750 that you see there must be the depreciation charge on the new truck for the current year because we no longer have the old truck. So keep that in the back of your mind. Lebogang has done a thorough study of specialized equipment. There. And based on a proposal, it was decided to change the method of providing for depreciation to the production unit method. Based on the number of machine hours spent in the conversion process, the current equipment was bought on 1 July 2015 and has a total capacity of 120,000 machine hours. Up to 30 June 2017, 50,000 machine hours were already spent. In the current financial year, an additional 20,000 machine hours were utilized. No equipment was bought or sold in the current financial year. She proposed that the reallocation method must be applied to bring about the necessary changes, and an expert has given her reliable information that the latest estimated residual value of equipment should be 40,000 rand, exclusive of VAT at the end of the lifetime of the specialized equipment. Good. Now the first thing that we have to calculate is the VAT inclusive proceeds received by Reroang for the truck traded in during the year. Good. So we're back here to the first paragraph question. We had a truck, cost price 1.3 million, accumulated depreciation up to the beginning of the current financial year 600,000. We have traded in that truck on the 1st of April. So therefore we've used this truck for a period of 9 months in the current financial year. So let's have a look. Cost price 1.3 million, accumulated depreciation up to the beginning of the current financial year 600,000. That gave us a carry value at the beginning of the year of 700,000. The depreciation for the current year being my cost price of 1.3 million, and we had an estimated residual value there on top of 100,000 rand over 5 years. So minus 100,000 divided by 5 years, multiplied by the 9 months that we've used it. So that gives us depreciation for the current year of 180,000 rand. The carry value of this truck at the date of disposal is now the difference there, 520,000. We made a profit on the disposal of 30,000. So that means that the proceeds on the trade-in of this truck, exclusive of that, was 550,000 rand. Now, what the question wants from you is the VAT inclusive proceeds. So therefore, we have to add the 15% VAT. So the VAT inclusive proceeds, 632,500 rand. Next, the question wants from you in the B part, present the property, plant and equipment known pertaining to the statement of financial position as at 30 June 2018 according to IAS 16 property, plant and equipment. The total column is not required. Now, whenever we get the property, plant and equipment note, write down your skeleton of the note first. We have two types of assets. We have trucks, i.e. vehicles, and we have specialized equipment. So at this point of time, we can actually complete the truck part of this question. So trucks at cost. We're going to start off with our carry value in the beginning of the year. Cost price 1.3 million, less accumulated depreciation of 600,000. So here's our note. Reroang Eng, notes to the financial statements for the year ended 30 June 2018, property, plant and equipment, vehicles, carry value as at 1 July 20. Isn't that 17 and 18? 17 and 18. Let's just rectify that. 1 July 2017, carry value as at 30 June 2018. Good. Cost price 1.3 million, accumulated depreciation 600,000. Then we know that for the movements for the period, we need additions at cost, disposals at carry value, and depreciation. At year end, we need carry value as at 30 June 2018, cost and accumulated depreciation. We have already worked out the carry value of this asset at the date of sale, and there it was 520,000, so we can insert that amount there, 520,000 rand. Nowhere in this paragraph they actually give me the cost price of the new truck. But what they tell me is what is our depreciation policy on the new truck. They tell me that we have an estimated residual value of 80,000 rand. They tell me that we write it off over 4 years. They tell me that we've used this truck April, May, June, 3 months of the year. And they tell me that the answer of that calculation of depreciation equals 88,750 rand. so we can work out the cost price of the truck. So the depreciation equals the cost price of the truck, which we don't have, X, less the estimated residual value, which is the VAT exclusive amount that we've worked out of 80,000 Rand, divided by 4 years. The estimated lifetime of that new truck is 4 years, and we've used it for a period of 3 months of the year, multiplied by 3 months. So if we take the divided by 4 is 25%, 3 months is also 25%. So therefore, if we're going to plot down this formula, it's X less 80,000 multiplied by 0.25 for that quarter there, multiplied by 3 divided by 12 is also a quarter, 0.25%. So 88,750, if we're going to multiply this out, equals an amount of 1.5 million Rand. So the cost price of the new truck being 1.5 million Rand. So we can insert that as well. They gave us the accumulated depreciation, 88,750. So we can just insert that in our little table here, 88,750, and that then gives us 1411250 carry value. Additions at cost price, we've just worked it out, it's 1.5 million Rand. And our total depreciation for the year, we can also insert that figure because we have it. Here we have 180,000 Rand worth of depreciation on the old truck, and we're going to add then the 88,750 Rand depreciation on the new truck. So in total, our total depreciation charge, 268,750. 268,750. All you have to make sure then is that this thing is actually balancing downwards. So 700,000 plus 1.5 million less 520,000 less 268,750 must bring us back to 1411250. Good. The last part of the question. Number C, prepare the change in estimate and the separately disclosable item depreciation for the year ended 30 June 2018. So this is all about the specialized equipment, and there was a change in estimate. Okay, Lebogang has done a thorough study. She has decided to be going to change to the production unit method based on the number of machine hours. Now for the specialized equipment, we have our cost price, 980,000. They've told us that this equipment was bought on the 1st of July 2015, and they also tell us that we have applied the diminishing balance method at 20% per annum up to the beginning of the current financial year. So we also have to apply the reallocation method to do the change in estimate. So therefore, our starting point is going to be the carry value of that asset as at the beginning of the year, which we do not have. So we have to work that out first. Cost price, as from 1 July 2015, 980,000. So we have used that for the full 2015-2016 year. 980,000 times 20% gives us 196,000. For the 2017 year, diminishing balance, it would have been 980,000 less 196,000 multiplied by 20%. So that would have given us depreciation of 156,800. Total accumulated depreciation as at the beginning of the current financial year, 352,800, which would have given us a carry value as at the beginning of the year of 627,200. If we did continue with the old method, we would have written off in the current year 627,200 multiplied by 20%, 125,440. Good. Now for the change in estimate. Let's continue this with this thing and we finalize the old method first. We said that, well, our carry value at the end of the year, let's write it in there, carry value 30 June 2018 would have been, based on the old method, 501,760. We would have written off in the future on the old way, and now, guys, that is where the estimated residual value suddenly becomes important. Remember what we've said is, we've said that this, with the diminishing balance method, the estimated residual value is included in the rate. That will mean that over the period that we're going to write off this asset, once we have written off the last 20%, it will end up with a 50,000 Rand value that is still going to remain in our books. And that 50,000 value will be the estimated residual value. So therefore, if we're going to do the future depreciation, we would not have written off the full carry value of the asset of 501760. We would have written it off to the estimated residual value, which will automatically happen if we apply the 20%. So therefore, the future depreciation that would have been written off on this asset would only have been 451,760. This is very important that you understand that included in the rate, we will only depreciate the asset up to its estimated residual value of 50,000. Therefore, in the future, we can only write off 451,760. Good, let's do the change in estimate then. Reallocation method says we start with our carry value of the asset as at the beginning of the current financial year, 627,200. Then we have to apply the new estimates on this carry value. We say here, we now estimate that the estimated residual value is going to be 40,000 Rand. We're also going to change to the production unit method. So if we're going to apply the reallocation method, we're going to take the carry value of the asset at the beginning of the year less 40,000 divided by the remaining capacity of the machine. Not 120,000. 120,000 is the total capacity. Of the 120,000, we have already utilized 50,000. So we have to subtract that from that 120,000. So here's our calculation. Our carry value at the beginning of the year is 627,200 less our new estimated residual value of 40,000 divided by our remaining capacity, which is the total less that portion that we've already used up to the beginning of the current financial year, multiplied by the number of hours for the current year, which was 20,000. In the current financial year, an additional 20,000 machine hours were utilized. And that gives us our depreciation charge for the year, 167,771. Now, based on the new method, our closing balance of our carry value would have been 459,429. We have an estimated residual value now of 40,000, so the future depreciation that we are in actual fact going to write off under the new estimate is going to be the difference between those two, i.e. 419,429 in the future. Now we have to do the change in estimate note as well as we have to complete the IAS 16 note as well. Now let's have a look. The impact on the current year's profits, what is that going to be? Well, if we did continue in the old way, we would have written off 125,440 depreciation. We are going to write off now 167,771, so it will be a negative impact on our profits of 42,331. Future depreciation based on the old method would have been 451,760. Now it's only going to be 419,429. So it's going to have a favorable impact on future profits of 32,331. Let's complete the IAS 16 note first. The cost price of the asset was 980,000 and our accumulated depreciation up to the beginning of the current financial year, there we've worked it out 352,800 with a carry value of 627,200. 352,800, 627,200. What is our actual depreciation that we're going to pass in our books in the current year? 167,771. So that is our depreciation charge, 167,771. What is our carry value at the end of the year? Guys, it's still a cost price of 980,000. That didn't change. That can't change. I've paid 980,000 Rand, and I can stand on my head and I can sing whatever song I want to sing. It's still going to remain 980,000 Rand. Accumulated depreciation is now going to be the 352,800 plus the 167,771, which equals 520,571, which will bring me back to my carry value at the end of the year of 459,429, and there we've used 459,429. Right, good, our change in estimate note. During the year, the method of depreciation was changed from the reducing balance method at 20% per annum to the production unit method. The effect of the change on the current year's profit is a decrease of 42,331. Let's just see. There we've worked it out. Decrease of 42,331, and the impact on future profits was a favorable 32,331, and future profits will increase by 32,331. Then our profit before tax note, that is also a separate note, so it's going to have, let's say, note number 5, profit before tax. Included in profit before tax is depreciation, and there you have to distinguish between the classes. Vehicles, last year, 240,000 Rand. And this year, 268,750. Now, there we have the 268,750, and then last year's depreciation, based on the old method, you would have worked out the total of 1.3 million. Just get that. 1.3 million less 100,000 divided by 5 years, that would have given you the 240,000. In the current year, we had the 268,750, which we have already spoken about. So that is then our vehicles. Specialized equipment, that is the one where there was a change in estimate. Last year, we've worked out that figure as well. We had depreciation of 156,800. There we've worked it out, 156,800. Our total depreciation for the current year, 167,771, but if we did continue in the old fashion, our depreciation charge would have been 125,440. So original estimate 125,440, that was our actual depreciation charge last year. The total depreciation this year, 167,771. There you have it, 167,771. So the impact on the current year is an increase in depreciation of 42,331. Therefore, it has a decrease in profits of 42,331. Last year, the total depreciation, which was also actually supposed to stand there, is 156,800. It doesn't want to show that. It's also supposed to stand 156,800. That is 0. So in total there, 156,800. Good. This is this question. You had to think a little bit. Nothing, it was not given to you everything with a spoon. But if you understand what you're doing, this was not a problem.